Welcome to today's Explainer. Right now, Bitcoin is absolutely tearing up the charts, chasing down new all-time highs. And honestly, whether you're a veteran hodler who's been around for years or someone who's glued to the daily charts, the intense volatility we're seeing right now is forcing a massive reckoning across the entire crypto space. So today, we're going to cut through all that surface-level noise. We are analyzing the actual underlying mechanics driving this current cycle. And most importantly, we're dissecting the ultimate showdown, the structural and psychological differences between long-term investing and short-term trading.
Okay, let's dive right into this. This right here is the inescapable dilemma facing literally every market participant right now. Do you deploy your capital immediately, stepping into the arena while all this market euphoria and momentum feels absolutely unstoppable? Or do you hold your cash on the sidelines, fight off that intense fear of missing out, and patiently wait for a structural pullback? Look, it is incredibly easy to let FOMO dictate your strategy when you're just watching the charts print green candle after green candle, week after week. The psychological pressure of sitting on sideline cash during a massive bull run is immense. But here's the thing. If you want to navigate this cycle successfully, relying on your gut feeling or getting swept up in social media hype is a total recipe for disaster. We have to ground our approach in how the market actually works.
Section 1. Why Bitcoin prices move.
To truly grasp the current price action, we really have to talk about liquidity and supply shocks. Because the upward trajectory of Bitcoin, it isn't just about everyday retail enthusiasm anymore. It is fundamentally being driven by massive institutional demand that is aggressively pulling supply right off the market. When major financial entities and those deep-pocketed large-scale investors begin accumulating, they rapidly deplete the OTC or over-the-counter desks. And what happens? That creates a massive supply shock. There simply aren't enough coins available for sale at current levels, which violently forces the price upward. But on the flip side, downward price action is rarely just simple profit-taking. We are in a highly leveraged market, so what begins as routine profit booking can very quickly trigger widespread market fear. And this fear, it acts as a catalyst for a cascade of liquidations. Long positions get totally wiped out, which forces automatic sell orders, which drops the price even further, which triggers, you guessed it, even more liquidations. It is a highly aggressive, constant tug-of-war between institutional accumulation and the brutal mechanics of leveraged wipeouts.
Now, what's really interesting about these specific catalysts is that they are exactly why Bitcoin is experiencing such intense volatility right now. These foundational market mechanics are being supercharged. We are operating in an environment where global economic policies, especially shifts in interest rates and central bank liquidity, act as this massive faucet for risk-on assets. Basically, when global liquidity flows, Bitcoin surges. Furthermore, the launch and the ongoing activity of Bitcoin ETFs have fundamentally rewired the entire market structure. We aren't just talking about traditional retail crypto money moving around anymore. ETFs have ushered in vast amounts of traditional Wall Street capital. And this capital doesn't behave like crypto-native funds do. It responds totally differently to macroeconomic data, it's bound by very strict compliance requirements, and it operates on completely different time horizons. When you combine this massive institutional influx with broader upcoming crypto infrastructure upgrades, you get a market that is primed for incredibly rapid and sometimes violent price expansion and contraction. Section 2. The strategy showdown. Long-term versus short-term.
And this brilliantly illustrates the most critical decision any market participant has to make. Knowing that this market is structurally designed to be volatile, how do you actually deploy your money? Well, the answer splits into two entirely different philosophical and operational approaches. First, let's look at long-term investing, which is often executed through dollar-cost averaging. This is essentially a strategy of psychological isolation. By deploying your capital gradually over an extended period of time, the long-term investor actively removes the anxiety of trying to perfectly time a local bottom or top. For them, volatility just becomes background noise. Instead of totally panicking during a 20% pullback, the long-term approach treats that dip as a mathematically sound accumulation phase. It requires immense patience, for sure, and an unshakable conviction in the asset's macro thesis, deliberately ignoring those wild intraday fluctuations. Conversely, short-term trading is an entirely different operational beast. A trader doesn't try to ignore the volatility. For a trader, volatility is the actual product, and that requires a profound shift in mindset. Short-term trading demands deep, rigorous technical analysis, a solid understanding of order flow, and perhaps, most importantly, ruthless emotional discipline. You are navigating sudden leverage flushes and macroeconomic surprises in real time. Without incredibly strict risk management frameworks, like unyielding stop-loss orders and extremely precise position sizing, attempting to trade these swings is essentially just gambling against algorithmic bots and institutional market makers. The failure rate is exceptionally high for those who jump in without a tested system, mostly because the emotional toll of watching a position plummet in a matter of hours can so easily lead to irrational revenge trading. Ultimately, long-term investing protects you from your own emotions, while short-term trading demands that you master them completely.
Section 3. Managing crypto market risks. Regardless of whether you align with that long-term holding philosophy or you prefer fighting in the active trading trenches, your survival in the crypto market hinges entirely on one foundational principle: capital preservation. Risk management is so often misunderstood as just some boring defensive tactic, but in a market where massive intraday swings are standard operating procedure, it is your absolute ultimate survival tool. Listen, capital preservation is actually far more important than capital appreciation. You simply cannot capture the upside of a parabolic bull run if your portfolio has already been wiped out by a massive, unexpected liquidation event. Acknowledging this extreme volatility means every single financial allocation you make must be rooted in your own rigorous research. Blindly following crowd sentiment or just copying trades from social media without actually understanding the underlying mechanics, that is quite literally the fastest route to a zero balance.
So the crucial point is delivering a very familiar axiom: invest only what you can afford to lose. Now, I know, while this might sound like standard, everyday financial advice, in the context of cryptocurrency, it acts as your primary psychological armor. Let me explain. When you allocate capital that you actually rely on for your daily living expenses, you become inherently emotionally compromised. If the market takes a sudden structural dive, that emotional compromise leads directly to panic selling, right at the absolute bottom. However, if the capital you've deployed is truly discretionary, meaning funds you can psychologically write off, you strip the emotion right out of the equation. It allows you to maintain your strategic framework, whether that means holding confidently through a brutal bear trap or executing a strict stop loss without a second of hesitation. Why? Simply because your real-world financial stability is never in jeopardy.
We've mapped out the underlying market mechanics driving this current cycle, and we've weighed the intense, rigorous demands of active trading against the steadfast patience required for long-term holding. So what does this all mean? The ultimate question isn't really about what Bitcoin is going to do tomorrow or even next week. The real question you need to ask yourself is, knowing your own financial realities, your technical expertise, and your emotional discipline, what is your true risk appetite? Answering that honestly is the only definitive way to survive and ultimately thrive in this cycle. Thanks for tuning into this explainer, and we will catch you next time.